Hey everyone, I hope you're doing well. I'm Simo, your host for today, and as someone who has worked as an equity research analyst for respected firms in the US, I'm here to share not just opinions, but real analysis of the stock market and the US economy overall. Today we're going to talk about something very important, the stock market itself. And not just in broad terms, but really digging into the three major benchmarks that most investors follow every single day, the S&P 500, the Nasdaq Composite, and the Dow Jones Industrial Average. Understanding these three indices is like having a roadmap to the financial system, because each one tells a slightly different story about where the economy is heading, what investors believe, and how money is moving in and out of the market. Let's start with the S&P 500. This is really the gold standard when it comes to measuring the US stock market. It tracks 500 of the largest publicly traded companies across all major sectors of the economy. Together, these companies make up about 80% of the total value of the US equity market. That means when you hear someone say the market was up today, they're usually referring to the S&P. What makes the S&P particularly powerful is that it's weighted by market capitalization. In plain English, the bigger the company, the more influence it has on the index. So giants like Apple, Microsoft, Amazon, and Nvidia carry much more weight than smaller companies. This has some very important implications. For instance, in the last decade, about 25% of the S&P 500's total performance has come from just 5 companies. That shows you how concentrated market leadership has become. Now, if we step back historically, the S&P 500 has delivered around 10% annual returns on average since its inception in 1957. But of course, those returns don't come in a straight line. There are periods like the 1980s and 1990s where it massively outperformed, delivering closer to 15% a year. And then there are lost decades like the 2000s where the index actually produced negative real returns after inflation, and the volatility matters too. The standard deviation of annual returns on the S&P is about 15%, which means investors need to accept a lot of ups and downs to earn that long-term average. But here's the key takeaway. When you're analyzing the health of the US stock market or even the global economy, the S&P is the broadest and most accurate picture you can get. The Nasdaq Composite, on the other hand, tells a very different story. While the S&P covers every sector from industrials to consumer staples, the Nasdaq is dominated by technology. About 50% of the index is tech-related companies, software, semiconductors, cloud computing, artificial intelligence, you name it. This makes it much more volatile, but also much more growth-oriented. If the S&P is a balanced portfolio of the US economy, the Nasdaq is the high-growth engine. And this isn't new. Going back to the dot-com bubble of the late 1990s, the Nasdaq skyrocketed from around 1,000 points in 1995 to over 5,000 in the year 2000, only to collapse by nearly 80% in the following 2 years. That was one of the most dramatic episodes of speculation in modern financial history. But here's what's fascinating. If you held on to the Nasdaq over the long run, even through that massive crash, it has outperformed the S&P 500 since the 1990s. The rise of companies like Apple, Microsoft, Google, Amazon, Meta, Tesla, and more recently Nvidia has made the Nasdaq the index most closely tied to innovation and the future of the economy. The Nasdaq also tends to trade at much higher valuations. If the average forward price to earnings ratio of the S&P 500 is around 18 to 20 times earnings, The Nasdaq often trades in the mid-20s or higher. That reflects investor expectations that these companies will grow faster. But it also means the Nasdaq is more vulnerable during times of rising interest rates or recessions. Growth companies derive most of their value from future cash flows, so when rates go up, those future profits are worth less today. That's exactly why the Nasdaq tends to underperform during tightening cycles and then explode higher during periods of easy monetary policy. Now let's bring in the Dow Jones Industrial Average, or the Dow as most people call it. This is actually the oldest of the three indices, created in 1896 by Charles Dow, the founder of the Wall Street Journal. Back then, it tracked just 12 industrial companies. Today, it tracks 30 large established blue chip stocks from sectors like finance, healthcare, energy, and consumer goods. What makes the Dow unique is that it's price weighted, not market cap weighted. That means companies with higher stock prices have more influence on the index than companies with lower stock prices, regardless of their size. So, a company like United Health, which trades at several $100s per share, has more weight in the Dow than a company like Intel, even if Intel's market cap is larger. Because of that structure, the Dow isn't as representative of the broader economy as the S&P 500. It's also only 30 companies compared to 500. But what the Dow does really well is provide a snapshot of traditional, established American industry. When people around the world want to know how the US market is doing in a very general sense, they often look at the Dow. And historically, the Dow has returned very similar numbers to the S&P. Roughly 9 to 10% annually over the long term, though with its own quirks because of the way it's constructed. Now here's where it gets really interesting. Taken together, these three indices create a kind of mirror of the US economy. The S&P is the broadest picture. The Nasdaq shows us where growth and innovation are heading. And the Dow represents stability and the old industrial backbone of America. When all three are moving in the same direction, it usually signals a very strong or very weak market environment across the board. But when they diverge, that's when analysts pay very close attention. For example, if the Nasdaq is surging but the Dow is lagging, it could mean that growth stocks are driving the rally, but traditional sectors aren't keeping up, which sometimes happens before a correction. Or if the Dow is strong while the Nasdaq is weak, it may signal that investors are rotating into value and defensive sectors, anticipating a slowdown in growth. One of the most important things for new investors to understand is how cyclical leadership moves between these indices. In the 1990s, the Nasdaq dominated thanks to tech. In the 2000s, after the dot-com crash, the Dow and value stocks outperformed. In the 2010s, once again, growth and tech powered the Nasdaq to record levels. And now in the 2020s, we're seeing periods where leadership flips back and forth depending on interest rates, inflation, and the Federal Reserve's policy. This constant rotation is why understanding the structure and behavior of these indices is so valuable. Let's also put some numbers behind this. Over the last 30 years, the S&P 500 has compounded at around 10% annually. The Nasdaq has compounded at closer to 13 to 14%. The Dow slightly lower, closer to 9%. But that extra 4 to 5% from the Nasdaq comes with much higher volatility. The maximum drawdown for the Nasdaq during the dot-com crash was nearly 80%. For the S&P 500 during the financial crisis, it was about 55%. For the Dow, a little less, but still significant. So when you hear that higher returns come with higher risk, this is exactly what that means in practice. From a valuation perspective, the current dividend yield on the S&P 500 is around 1.5%. The Dow yields closer to 2%, and the Nasdaq, because of its growth focus, yields only about 1%. Price to book ratios are higher for the Nasdaq, more reasonable for the Dow. These details matter because they tell you how much of your return is coming from income versus capital appreciation and how expensive stocks are relative to fundamentals. So, what does all this mean for someone trying to learn about the market? It means that no single index tells the full story. The S&P 500 gives you the big picture. The Nasdaq gives you a lens into the future and where innovation is heading. And the Dow gives you the pulse of traditional established corporate America. Together, they create a comprehensive view that analysts, portfolio managers, and policymakers rely on every single day. Finally, I want you to subscribe only and only if my research has convinced you enough as fair act. Anyway, take care, guys.